AI has given investors whiplash. Everyone's either overhyping it or calling it a bubble. But buried under the noise are two stocks the market's completely mispricing. One's being punished for stability, the other's being punished for success. These are my two AI picks for November and why both sides of the hype cycle are wrong. Let's start with Adobe. Proof that slapping AI on your product doesn't guarantee a stock rally. Adobe's trading at just under a 15 times forward earnings, its cheapest multiple in nearly a decade. The company's still growing earnings at 10 to 15% a year, generating strong free cash flow and buying back stock aggressively. Wall Street, however, expected massive artificial intelligence-driven revenue growth, and when it didn't appear instantly, investors punished the stock heavily. The fundamentals haven't changed, but the headline narrative has investors spooked. Wall Street wanted fireworks from AI. What they got was stability, and stability is exactly what long-term investors should want. Adobe isn't promising meteoric revenue growth, but it executes consistently, grows earnings 10 to 15% a year, and returns cash to shareholders through buybacks. The stock might be beaten down now, but that's exactly the setup for serious compounding over time. Adobe is trading at a forward PE of roughly 15 times, which implies a 7% earnings yield even before factoring in growth. Add in consistent earnings growth of 10 to 15% annually, and the potential total return jumps to 17 to 22% per year. If the market eventually re-rates the forward price to earnings ratio from 15 to 19, 5-year returns could reach 185%. Or about a 52% upside from today's price. Even under more conservative assumptions, let's say growth slows to 8%, investors are still looking at 15% annualized returns, getting paid to wait while the market slowly realizes it has overreacted. Wall Street is treating Adobe like it failed at AI, when in reality, AI is making its products stickier and more indispensable. Generative artificial intelligence alone doesn't compete with Adobe. It enhances workflows. For myself, when I try to generate an image on a standalone AI tool, it might take 20 to 50 attempts to get something usable. But Adobe's artificial intelligence lets you edit each part of the image instantly, whether it's adjusting a person in a wedding photo in Lightroom or fine-tuning layers in Photoshop. The market is underestimating this subtle yet massive advantage. Adobe's artificial intelligence isn't about instant revenue fireworks. It's about making tools that professionals can't live without, cementing long-term adoption and compounding returns for investors who understand its real value. The main risk is competition from standalone AI image tools, but switching costs and Adobe's entrenched ecosystem make it unlikely professionals will jump ship. In the meantime, investors are being paid 15% plus annualized returns from earnings growth and buybacks while waiting for the market to realize it has overreacted. Adobe proves that steady execution and real product value often outperform hype, especially when AI is misunderstood. If Adobe shows what happens when the market punishes stability, Nvidia shows what happens when it punishes success. This is the company everyone calls a bubble, even though it continues to deliver record-breaking growth and dominates the AI chip market. Let's break down why the market is misunderstanding Nvidia and why that creates one of the most compelling long-term opportunities in tech today. Nvidia trades at a forward price to earnings ratio of roughly 30, which might feel expensive at first glance. But the company has a history of delivering at least 15 to 20% annual revenue growth and at least 20% plus net income growth. Analysts are projecting 47% EPS growth for next year and 25% the year after. Nvidia dominates the artificial intelligence chip market, powering everything from advanced language models to image and video generation, and is the go-to supplier for the fastest next-gen AI hardware. Despite this, many investors call it a bubble, misunderstanding both the pace of AI adoption and the structural growth Nvidia is capturing. People call Nvidia a bubble because of its high valuation, but that's missing the bigger picture. This is a company with real, measurable growth, dominating the AI chip market and consistently compounding earnings. Assuming 25% EPS growth over the next 5 years and a constant forward PE of 32.5, Nvidia could deliver 205% total return or 73% upside from today's price. Even if the multiple contracts to 20, investors would still see an 88% return over 5 years, comfortably outperforming the S&P 500. The market is mispricing Nvidia not because it won't grow, but because it doesn't understand the scale and the stickiness of the artificial intelligence opportunity. Calling Nvidia a bubble misunderstands what's actually happening. Unlike the infamous tulip bubble, artificial intelligence chips have real utility, powering millions of daily interactions and enabling entirely new applications. Lack of immediate revenue doesn't mean lack of value. It means we're in the build phase before monetization. Think of it like leaving a hammer and nails in a room. If no table appears, the hammer isn't useless. It just hasn't been used correctly. That's AI today. Give it clear guidance and it performs remarkably. Leave it vague and it can frustrate users. The hardware side is just as important. Each new chip generation doubles memory and capability. Moving from general purpose GPUs to artificial intelligence specific chips produces exponential performance gains. This isn't a plateau. It's the start of a new accelerating growth cycle. Finally, the psychological angle can't be ignored. Many call artificial intelligence hype because it's easier to assume their skills won't be replaced. But reality is harsh. AI is real, it is accelerating, and it is transforming industries. Investors who see past the fear and understand the mechanics are positioned to win. Nvidia isn't a bubble, it's a dominant compounding growth machine in the artificial intelligence era. With next-gen hardware, structural market advantages, and accelerating adoption, the company is poised to continue delivering outsized returns while most investors remain focused on whether AI is in a bubble. Both of these stocks are misunderstood for opposite reasons. Adobe for not being AI enough and Nvidia for being too AI. But both are executing, both are profitable, and both are long-term compounders trading at attractive prices. In November, while the market debates the artificial intelligence bubble, the opportunity is clear. Steady execution and real artificial dominance are where the returns are hiding. Which of these do you think has more upside? Adobe or Nvidia? Drop your pick below. If you've stuck around this long, join me on Discord, link in the description. I can't wait to talk about stocks and investing with you. Thanks. Bye.